Welcome to Stifel's Sightlines podcast, focusing each week on a topic or two important to investors. Well, greetings and welcome to the Sightlines podcast. This is Michael O'Q, Stifel's Chief Investment Officer. Hey, in this episode, I want to get into kind of a heavy topic, and that's the trajectory of the U.S. debt. And what we really see is the need for a fiscal transition. Now, we've actually been talking about the concept of fiscal transition for a number of years. And this is where across our economy, consumers, businesses, and our government all have built up debt in the wake of the Great Recession after interest rates were brought down and kept low, right? So debt has been building and building. And now that rates are back to a higher level, it's bringing into focus the cost of that debt, and essentially the segments of the economy will have to go through a transition. We're kind of seeing that with consumers. We're kind of seeing that with businesses. That all happens incrementally, but our government really hasn't changed course. We've been basically deficit spending and building debt for a while now, and we think it's time that comes into focus. Now, obviously, on the political side, there's really no appetite to talk about it. And so we'll get into sort of how the leadership more broadly in the world and in our economy may have an influence on this. In any event, let's get into some numbers. The Congressional Budget Office, CBO, is essentially estimating the deficit for 2024 at $1.8 trillion, and that will bring our total debt up to $35 trillion, which is a pretty already an alarming level. Now, the cost of our debt, what's called net interest, is estimated to be 16% of our revenue, 12% of our spending. So again, we're spending more than we bring in. And over a third, so roughly 35% of our discretionary spending. Now, the CBO also does future forecasts, like forecasts out into the future. They're estimating the deficit in 2034 to be $2.8 trillion. And the debt to have grown to an astonishing $57 trillion. Now, the cost of our debt at that point, 43% of our discretionary spending, so well above current levels. Now, those are pretty big numbers, and obviously the whole idea is to kind of reverse it, right, and balance the budget, hopefully at some point, and start to try to figure out ways to bring debt down. And what we've seen this year is a drumbeat of sorts among corporate leaders, especially in financial services, to focus in on this issue. So, for example, BlackRock CEO Larry Fink has said, quote, "No one is spending enough time talking about deficits. We need to be finding ways to minimize the role of the deficit," end quote. Jamie Dimon, that's the CEO of JP Morgan Chase, said, quote, "Any country can borrow money and drive growth. America should be quite aware that we've got to focus on it more," end quote. And then finally, CEO of Goldman Sachs, David Solomon, said, quote, very straightforward, quote, "Policymakers need to put greater risk on the ballooning debt and deficit," end quote. So it's good to see, leaders of big financial services firms finally raising this issue and bringing focus on it. And we're hopeful that will lead to a focus from the political establishment. Now, obviously, we're weeks away from an election, so nothing's going to happen before that. But I'm kind of hopeful that we get through this election, and however it lands, that we'll hear a bit of a drumbeat to start to focus on this issue and try to chart a course towards improving things here as we move through time. In any event, what are the risks? It's in some ways foundational, right? The first would be that investors start to lose confidence in U.S. Treasuries, which right now are viewed as a safe investment. That would lower demand and cause rates to go up further. Number two would be the role of the dollar. So the dollar is the world's reserve currency. A weaker dollar or a risk of that status as the reserve currency is problematic. And then finally, overall, those two sort of anchors to our financial system, a reserve type currency in the dollar and treasuries as a safe asset, to the degree that those are at risk or questioned, that can be foundational to the capital market. So there's a risk of contagion affecting other bond markets and the equity markets as well. Now, just want to emphasize, we don't think we're there yet. We think that there's still very much an opportunity to sort of tighten our belt and move in a direction to improve things in terms of the financial circumstance of the U.S. But time is clipping by, and it needs to come into focus for our politicians. In any event, that's what I wanted to cover in this relatively short but kind of heavy episode. Thank you so much for listening. And, we'll be talking about this more in coming weeks and months, but wanted to kind of get the issue out on the table. So again, thanks so much for listening, and we'll catch you in our next episode. Thanks. Thanks again for listening to Stifel's Sightlines. Be sure to subscribe wherever you're listening to automatically receive each week's podcast in your feed.